right? A very warm welcome to my panelists as well, right? Fred's panel was amazing, as usual, right? Okay, there were some very helpful hushes, thank you. Right, and I think Fred's panel talked a lot about how policy, standards, corporate action can drive carbon finance forward. I think this panel does a little bit of a change in pace. Right, I think we hope to talk more about how private capital can be most effectively channeled to drive technological innovation and decarbonization. Right, I think my distinguished panelists here today, right, represent global investors who actually invest into climate technologies all over the world. Right, and I think we hope to cover quite a lot of ground today. Right, we're going to talk about geopolitics and the impact of fragmentation on companies and investors and investment decisions, of course. We're going to talk about the complementary roles and the relative advantages of Asia, right, and the West in climate technology. And we're also going to be talking about capital allocation. So that all sounds very heavy going and potentially a little bit dull immediately. So I would like to kick us off with some hopefully interesting data points, right, that will get us thinking. Right? So I think we have prepared some simple multiple choice questions, right, because we're Singaporean, we like standardized tests. Okay, so that will be something we can all do together. So I think if you go to your Pigeonhole, scan your QR code thing, we have some questions that I would love some answers to, right? And they're MCQs, so just participate. Okay, so the first question, which country has the most EV and battery-related patents in the world? This one is an easy one, right? So this is a give you an easy start one. So there's China, Japan, South Korea, and the United States. Okay, so I think you can vote. We should pull up the answers as people start to vote. I feel like Bing should know the answer to this one. Can we pull up the answers, please? Okay, should we actually, okay. I think people are taking very long to answer this question.
They think it's a trick question.
Yeah, is it a trick question? Sorry? Oh, it's a, okay. All right, so I will give you the answer. Okay, that's okay. Right, so I think China, no surprises, right, is the country that has the most EV and battery-related patents. Okay, so and it's followed by Japan, South Korea, and then the US. So I think that's no surprises, right? But I think what's surprising for me is that actually Northeast Asia, quite clearly, is in the lead when it comes to this field, right, as a collective. Right? So that's something that was interesting to me. Now if we go to the next question, if we bring that up, please. Right? So which country has the most capital channeled towards climate finance? Right, and again, it's not a hard question, I don't think. Right, so if you could vote, we can see how that goes. I don't know if people are voting. Can we pull up the answers, Deanna? Or? Okay.
Oh.
Oh, yeah. Oh, wow.
We have a perfect answer.
Guys, what happened here? Okay. Okay, so that's the wrong answer. So if we pull up the answer page, okay, so actually it is the United States, right? Yeah, and actually the United States still is the global leader. I guess the question, the answer is it remains the global leader, right, with the world's deepest capital markets. I think if you take Europe, you know, comprising, say, UK, Germany, and France, it comes in second, which is on par with China, roughly. But it's interesting to see how, you know, perceptions of, you know, China's investment into climate finance has really taken off. Okay, now we have the last question, so if you bear with me, the last question that we have. So which were the top 3 countries in the world, right, last year, 2025, with the highest EV penetration? So this one is a little tricky, right, so I'll give you a little bit longer. Oh, wow. Okay, we can have the answers come up. This is very interesting to me. The correct answer actually is Norway, Nepal, and Ethiopia. Right? And I thought this was a really interesting one. Norway, I think, is quite well known, I think, in terms of high EV penetration for various reasons. But Nepal and Ethiopia, perhaps less so. And I think Ethiopia in particular, right, really stands out because I think it really shows how government regulation, in this case, tariffs on ICE cars, really made Chinese EVs gain a lot of ground, right? And actually, it shows us really a lot of things. Firstly, Ethiopian government did this, right, in order to actually reduce energy dependence, right? And so by doing this, actually, they thought it would help, right? So where climate intersects with energy security, right, we really see that green technologies can really be supercharged in terms of adoption, right, and ultimately also made possible when you have affordable technologies, right, that can actually be competitive in such markets. So that wraps up our MCQ section of this panel, right? But we will sort of pivot to Bing, who's a logical person to speak to, right? So Bing is co-founder and managing partner of Rockets Capital, right? And Rockets Capital is of course anchored by XPeng, right, a Chinese EV champion. So my question for you is, how do you invest in the EV and clean energy supply chain, right, amidst all the geopolitics that you see today? And in particular, how do you see Chinese companies creating a meaningful revenue base for themselves overseas, considering all the challenges they have to go through?
Maybe I'll start with your question and answers. Actually, I'm surprised by two answers. I thought coming from China, we know all the multiple choice answers. So I'm surprised that one, China is not the largest funding country yet of clean tech investments. Second, the EV penetration in some smaller markets actually higher than China. So China last year's EV penetration of passenger vehicles is about 54%. Very respectable for that big market, but still lagging some of the, I think, especially North European countries. So to answer your question, Kimberly, given that XPeng is a leading EV company in China, and they actually are one of the leading companies exporting vehicles globally. So when we look at their supply chain, so from batteries to motors to silicon carbide chips. So as we move from electrification to more smart and more intelligent vehicles, we're also looking at a lot of AI chips as well, smart cockpit. So that gives us, some advantage in terms of industry insights, as well as advantages in terms of deal sourcing, as well as due diligence. To answer your question, how do these Chinese companies need to make money overseas or to have meaningful overseas revenue? I think that's a very, very challenging question. I think China clearly has the strongest supply chain in many, many aspects, including lithium batteries, energy storage, EVs. But you can't just export your way out of growth problems within China. I think in many sectors, I think Chinese capacity is probably more than the world can take. In solar, China's more than 90% of global supply. Lithium batteries more than 80%. The EVs probably 67%. So I think it's very important for them to actually have overseas operations in order to generate more overseas revenue. So we are talking about migrating from just pure export to what we say, going overseas 2.0, meaning you have to have local manufacturing, you need to have local partners, you need to have local component sourcing, etc. So using our anchor investor XPeng as example, they already have assembly plants in Indonesia and Malaysia. So they are not just exporting vehicles from Chinese factories into these markets, but rather than doing a final assembly in these markets. And then they are also actively looking for sites in Europe as well. So one of our portfolios, which is also leading battery company, EV battery companies in China, they also are setting up factories in Thailand. So I think that's one way, is to set up local manufacturings to be more local and to sell into those markets. Secondly, I think it's more combining with international capital, especially capital in Singapore in Southeast Asia. So one of our portfolio, which I think some of our friends also co-invested, it's called PCG Power. They are doing distributed PV. So they are also in Indonesia, in New Zealand. So I think they are attracting international capital from Singapore, from Middle East, to help them better penetrate those markets.
Right, understood. So it's about being very thoughtful about how you penetrate overseas markets beyond just an export of finished manufactured products, but also thinking about business model innovation in the context of PCG. No, that's great. And Swetchi, as an investor in climate technologies globally, how have geopolitical tensions and tariffs impacted your portfolio companies and your investment strategy? Do you think that tariffs can really confer a sustainable advantage, right, for Western players?
Yeah, thanks, Kim. So for Decarb Partners, we are investors in growth companies globally, and we have significant exposure to US company, and in APAC, we're particularly constructive on Chinese company. And so this question is like top of our mind. And to answer your question very directly is that I think tariffs will give a short to medium term type of protection to the Western companies, because it basically reallocate value and forces a reconstitution of local supply chain. But ideally, the Western players can take advantage of this period of time to basically build that structural moat, climb up that learning curve and get to the cost type of structure that the Chinese player have, and eventually this tariff or any kind of subsidy protectionism fall off. But of course, in reality, it's not as straightforward as that. That takes time. And we talk about that very extensively in the questions, is that ultimately Chinese companies are still very dominant in the climate tech manufacturing capacity. We can't take that away. And I think we need to look a little bit like why they're particularly dominant and successful. I think there's like maybe like 4 factors. One, I mean, technologically competitive. 2, they have got to that manufacturing scale, right? And that scale is because of that very strong process know-how, as well as kind of mass production learning. And then the next thing is they have this crazy supply chain. It's industrial coordination at the system level with speed and scale. So that's not so easy for any other country to just replicate quickly overnight. And so what this means is that the tariffs will slow down the Chinese companies' immediate expansion, but it doesn't take away their inherent cost structure and capability. And I will give some specific examples that we came across, right? Because the last factor that the Chinese companies need to crack is how do they get geopolitical acceptance in this world of like so much tension. And the Chinese company have been open-minded, very, very, very receptive, nimble, right? CATL is like the most well-known example. Ford chose it for its capability, its technology. It wanted to build the plant in the US, but got deterred. It quickly pivoted to a licensing model. In a way, it's kind of a perverse positive effect from over-competition in the Chinese domestic economy for so many years. The Chinese company became so open-minded, and they can accept a positive economic outcome, even if it's a smaller one. And then another example is that I spent quite a bit of time looking at energy storage manufacturer in the US, and this is a Chinese origin company based in the West Coast. And they have really localized the production there to meet the local content that US wanted. So, but yet, its cost of production is most competitive amongst the players that we've seen. And how it has done it is basically imported in very cost-efficient assembly robots in the factory. And that factory can produce $1 billion of revenue a year if it's operating at full capacity. And that bypasses the labor laws, labor cost issue in California. So then the last point I will cover is, when it comes to investment strategy, then what does it mean, right? For Decarb Partners, we want to invest in companies that can survive and thrive in a multipolar kind of world. And our strategy evolved with this geopolitics. So kind of rewind back to a few years ago, in our APAC strategy, we focus on Chinese companies that is 100% domestic consumption, 100% supply chain, And so no noise around this, can export or not their products kind of risk. And then fast forward to today, we're now focused on the opportunity where Chinese companies are looking to international, which is what Bing is saying, and we bring tremendous value to this company, being an international shareholder on their cap table. And I think for us, there's a lot of value play there, because of unique network that we bring to the table. And then the last point, I don't want to forget about the Western company, because we have so much exposure. We believe that there are breakout plays there, especially in these sectors that the Chinese are good in, because of very specific, say, sector or state kind of advantage that companies may have.
Understood. No, that's very clear. So your investment strategy has already evolved to incorporate geopolitical considerations, and there will be companies, whether in China or the US, that can still stay resilient regardless of what is thrown at them through business model innovation and continued manufacturing advantage. Now that's clear. And so maybe going to Anil and Julian both. Right, so you both cover climate technologies globally. Now, do you see a division of labor, perhaps, between Asian and European innovation within the climate stack? Right, maybe we'll start with Anil first.
What do you mean? What does division of labor mean?
I mean, if you think about, this is very good. I see what you've done there. You've asked me a question. Okay, but so in traditional,
I want to clarify.
No, in traditional economics, right? I think we see countries specializing in what they're good at. Right? Do you see the same in climate technologies, right? Between the US, India, China, like where do you see the best companies and the best types of companies from each region?
I think you find good companies everywhere, all across the world. The question really is what types of founders are showing up. We found extraordinary companies out of China. I've backed a Chinese company in the past called Autoflight. I've backed companies in India that have done extraordinarily well. Again, I think when we think about big problems, we're really trying to back companies with really strong founders across the world solving really tough problems. So I think we're agnostic in some way, shape, or form when we're looking at investing. Again, I speak from an early stage investor perspective. I don't know, Julian, how do you feel about that?
I mean, pretty similarly in many ways. First of all, thanks for the invitation, GenZero, to speak today. I think it's a great opportunity to have folks that we've co-invested with. But we don't really see a division of labor. I mean, Eurazeo, we straddle 16 offices globally in Asia and Europe mostly. And we're not seeing in the last few years, this division of labor. But what we have seen, and that's been interesting for us, specifically in Singapore, is that we've engaged in China and we've invested in China, and we have found that China has been incredibly helpful and strong in bringing renewables and more decarbonized products to emerging markets. And I would say, relatively speaking, it's sadly because I am a French national, Europe has not been as strong. And I say this because China. I did my stays in China. It doesn't appear, but I'm a Mandarin speaker. I work with a lot of founders there, and a lot of my friends in China were born fairly poor. They born in the 70s. They know what it's like to come from an emerging market. They know how Chinese entrepreneurs we work with. They know how to sell. They know how to be flexible. They know how to bring the right price point, and they've been incredibly successful in advancing electric vehicles, battery storage into emerging markets. And that is true that over the last few years, it's been a huge advantage for us working with Chinese entrepreneurs. They have been able to prove at a scale to bring the price points that, frankly, made the products finally competitive on a unit economics basis with a legacy. And I think that's a huge contribution for us, and that is something that is new. It's not a division of labor. They've taken the full scale. From designing the industrial policies to then implementing the industrialization and then rolling out the products, right? Unfortunately, Europe, where historically we'd been very strong in inventing technologies, we haven't been able to scale them. We've lost industrial muscle. I think it's pretty clear. You've seen the examples of Northvolt. I think there's other examples, unfortunately, where we've been able to raise the capital, but we haven't been able to produce. And that results in the fact that we're not today producing products in Europe that are competitive for emerging markets. And that is a significant problem that Europe is contending with. We are now trying to regain that. We're trying to essentially control our supply chain better. And that's been a dynamic that Eurazeo we've underwritten. We invest in Europe a lot for Europe, and companies are doing well there, but we're underwriting companies in China specifically around products because they're going in strong in all markets, not just in China, in emerging markets, but now also in Europe. And friends from Xiaopeng will be able to tell us more about that as well.
Yeah. So in a nutshell, it's less about a division of labor. It's more about advantages in cost structure, enabling an access, a differentiated access that Chinese companies may have to certain emerging markets, which perhaps the Europeans are not able to do today. Okay, that's clear. And so maybe going back to Bing as well, and Swetchi, and this question goes to you both, but where you talked a lot about the conventional wisdom, right, around the Chinese advantages in supply chain and manufacturing and hence cost. Are there areas where the conventional wisdom doesn't hold true and might be surprising in terms of where the Chinese companies may stand out or where US companies may surprise in terms of where they are?
Let's start first.
Yeah, I'll go first. So I think the first MCQ question just now kind of gave it away, right? Chinese owns some 75% of the patents in clean tech, but that's very concentrated in solar, EV, and battery. But the definition of innovation is not simply like an initial lab invention. It's initial lab invention plus the process know-how and the mass production learning. And I think the Chinese has basically done it in all these three pieces very well, right? And I will even go further to say the way they go about this, I call it the learning loop, is like they basically scale, they iterate, and then they improve. And then they keep doing this at like faster and faster iteration. And to the extent that, you know, that learning, the so-called innovation is almost incremental, but very rapid and a high volume. And so some examples of that. Last week, I was in Guangzhou. We spent time with XPeng, eVTOL business, the electric vertical takeoff and landing, and their humanoid robots. And one of my biggest takeaways is there's so much synergy between their EV business and all this humanoid robotics and their eVTOL business. So I think that is something that we shouldn't forget, right? That innovation is just more than that pure innovation. And then there's, of course, we spend time in the Xiaomi and the Huawei showroom, and that's exactly how they pivoted. I would say pivoted. They added their EV business to their consumer electronic kind of suite of product. So I think all in, this just goes to show that it's not about who invents it first, but who can scale, who can iterate, who can deploy the fastest and the cheapest at scale. But in a way, the Chinese companies sometimes may overdo it, right, to the extent that it kind of damages their returns. So I think this part we just need to be kind of cognizant about. But on the Western companies, I think there are certain sectors, like say in the US, they are dominant and they will continue to be very dominant. And these are sectors that we are very positive about. For example, space satellite business. The US has decades of experience, system integration software, the customer network that cannot be replicated overnight. And they continue to enjoy that manufacturing mode there. So I think the US do have that manufacturing know-how, but you know it can be better kind of spread across more sectors.
Yeah, just go back to your earlier questions about division labor. I don't think there's a clear division labor, but there are relative strength and advantages. Yeah. So I think for China, I think the strength is still in hardware supply chain. I think the US clearly, I think large models and software is still leading the world. So I think the ideal world, if we can combine China sort of value for money, low cost supply chain with US software and then sell globally, that's the best combination. But unfortunately, I think this convention wisdom doesn't work anymore. So I think there's actually a role where Singapore and ASEAN can play a role. Because one, I think a lot of Chinese entrepreneurs and investors, including us, are finding ourselves stuck between the rock and the hard place. Because on the one hand, there are certain advanced technology that China doesn't want to export, and especially in the race for AI, U.S. Despite President Trump's summit with Xi, I think the high-end GPU chips you can still not export into China, and a lot of AI data. So we look at data collection companies. So the Chinese generate data cannot be exported, and U.S. don't want those data either. But if the data generated in Singapore and Asian countries, then that's okay. So we are actually looking at a number of AI companies that could tap into Chinese supply chain and technology, but because they're Singapore incorporated, they can supply to North American companies. So I think if we could make that work, I think that could be a new, interesting opportunity, not only for Singapore and Asia, but I think for the US and China as well.
Understood. So from Swetchi's perspective, innovation on top of innovation, going from one domain of EVs into ancillary domains, that's one bucket. And then I think from Bing's perspective, leveraging Chinese hardware dominance with potentially ways of accessing the US software for a combined product, I guess that could be a very compelling way of conquering the world. Okay. Now, moving on to capital and going to Anil. You talked a lot about how you can find good founders anywhere, right? Effectively, it's all about finding the right management team to support and back, right? But what has that experience been like, right? Looking for such climate tech opportunities in Asia. And of course, Asia is not just one big patch that is known as Asia. So maybe give us a little bit more granularity in terms of what you see in the different markets.
Yeah, I think it's a really interesting question because we see Chinese companies have incredible founders, incredible talent, and they also get a lot of support from the government. So they get, for example, one of my companies, once they got the seed financing, right after seed, they were able to get like a 700,000 square foot of manufacturing from capacity from the government, and no US company would get that, ever. And it's super hard for US companies to go execute in a way that the Chinese founders do because they make their own carbon fiber frames, they make their own chassis, they make their own everything, right? So it's a really incredible thing that we see in China. However, it's very hard to get money out of China as an investor. So that becomes a real challenge, right? Then with Japan and South Korea, a lot of the talent coalesces in large companies. We really want these younger folks to get out and want to work in startups. And I'm a huge proponent of startups because I'm an early stage investor. So we have the talent sucking problem in Japan and South Korea, but there's a lot of technology available in both these geographies. India has both talent and the right policy, but India lacks growth capital. There's not enough growth capital available like how we have in the US or in Europe or elsewhere. So I think every country and space has its own challenges and opportunities. I would call it a triangle: capital, policy, and talent. And I would want all three to be available for us to make a big move towards some goals here.
Okay, it's a high bar, right? But from Julian's perspective, what can Asian companies do differently, maybe, in terms of governance, in terms of IP, in terms of regulatory sort of traction to become more investable for the likes of Anil?
Well, I think the first point to understand is, because we address all these markets, Europe, across Asia, first of all, we're finding that there's becoming a premium for funds that can work across markets. I mean, for a fund that's based in Singapore, based in Europe, that can be in Europe, that can be in China, it can be in India, Japan, Korea, if you can work across markets, at the end of the day, you're more capable to help these entrepreneurs, because at the end of the day, we've co-invested together in an EV logistics company in China. We've brought in as well GIC, so we've done that with Bing. We've co-invested with PCG Power. We're scaling that company, and at the end of the day, what we're looking for is we look for 4,000 companies to do 20 investments, right? So we need to scout the world to find the best entrepreneurs, and then once we have them, we need to be able to find a ground where we can bring each one of our respective value to the entrepreneur to build the best company and the best financial outcome. That's why we co-invest and play a different role. So when we're looking at companies, we're certainly thinking about, okay, where are they from initially? And that sometimes will kind of make us think about where we need to kind of emphasize and what kind of partners we need to bring in on board as well. So if I make it simple, from our perspective here in Asia, when we're looking at Japan, Korea, I would really second what Neil is saying. The deficit is around mindset. We're seeing amazing technologies, but we're not able to get the talent pool to build more regional, even global companies. As you said, they've been stuck in large corporates. It's not easy for them to build these companies that have the culture to go beyond Japan. And I can tell you, I've been scouting the Japanese market for 3 years. I can say there's probably 1% of the market that's addressable for me. If you're a Japanese investor, you want to invest in a Japanese company for the domestic market, there is. But if you're looking for a technology company, you want to scale across Asia, not that many. So in Japan, that's something that's really important for us. In China, clearly, we're looking for companies that, as Bing was saying, yes, they're strong in terms of the unit economics and their ability to scale products, but now it's a more complex world where they need to sell beyond China. That's where the margins are. And to sell beyond China, you need to build alliances, you need to build local manufacturing, you need to be building goodwill. We don't want to underwrite a Chinese company where we feel that in 5 years they're going to have a massive backlash and we won't be able to exit, right? So that's something we're thinking about in China. In India, for us, we've invested there. One of the things that we're paying particular attention to is how IP is being acquired in India to manufacture quickly things that India did not maybe invent. So India, we're looking at the ability to transform IP into products and to see if we can get that manufacturing excellence that can clearly balance what China's been doing. And the last point is Southeast Asia. So we are in Southeast Asia, and I would say here we have invested successfully. Companies like TransTrack in Indonesia providing data for logistics. There's some real pain points, but the problem is affordability. At the end of the day, everyone wants these more sustainable solutions, but the affordability question is so critical. I mean, the per capita income in Singapore versus the per capita income in the Philippines, it's not the same market. How can people address the same and get the same product? And here I would say the question that we're thinking about is the cost of capital. We need to reduce the cost of capital for these solutions to make them affordable, and we never are starting with disruption. We're starting with a mature product that's been tested, proven elsewhere, and we're really working on the unit economics to bring it to a market in a situation that people who have less income can afford it. So different dynamics. At the end of the day, the starting point is different, but we always seek to build alliances, and that's why we're able to bring in different investors from different parts of the world and different parts of the capital stack, which is another issue.
Right. So there's a lot of value creation that as investors you have to do for companies coming from different contexts and operating environments. And Swetchi, actually Decarb has one of the most, I would say, diversified LP bases, right? Not just typical Western LPs, but also Asian LPs. So maybe talk a little bit about how you got both Asian and Western LPs, right, willing to invest in companies in China, right? Given that that's also a part of your mandate.
Yeah, that's right. I think your question is really around, how do we get more Asian capital towards your Asian climate solution? And I think there's no lack of capital in Asia, and we have seen so much capital gone into supporting China, right? So maybe we talk more generally Asia, kind of sort of ex-China. I think the investors here are pragmatic and they want to see the visibility to scale up. They need to see there's policy alignment. They need to see good execution. So basically, they need to see de-risking. And they are not going to invest because of sustainability purpose or so that it fulfills certain green objectives. Ideally, we want both, but I think Asia investors are focused on the former than the latter. And then the second part is really around the Asian economies have been built on very top-down industrial policy in many, many countries. So I would say to attract investors, you need to show some of these characteristics. And if I'm an Asian solution, a climate company, I need to present myself as really industrial competitive. And then as an investor, what they can also look at is where's the tailwind, right? For example, in India, there's very clear top-down on localization. Localization, not just because government said so, but also there is a real economy need in India because it has to be the right price point for the Indian economy. So we saw opportunities in the commercial vehicle space in India, like e-buses and trucks, etc. And those are sectors that we see a lot of capital because people clearly see that policy alignment tailwind. And then a bigger thematic, which everybody has been very hot on, is really like the AI data centers. And Asia is has a very big regional play on this thematic. And we know that drives a lot of power need, power electronics, grid connection, and I think that will drive a lot of the demand for decarbonization solution. And so, when people are aligned with that big thematic of data center build out, naturally they will invest in the Asian solution for this.
Right, so leaning into the thematics to attract the capital. Right, and then given all that has been said, what do you think is the outlook for funding for Chinese climate tech solutions? Right, is it likely to still remain domestic, or do you think we can count on more international capital flowing in?
Yeah, I think it's getting more and more challenging. I think, since the geopolitical situation got more and more challenging, a lot of Western capital started pulling out of China. So traditionally for VCPs, we used to say, two of our ends are offshore. So we got our, capital from Western LPs. We invest in China. They ultimately get listed in US, Singapore, or Hong Kong, and we exit that way. But I think that model no longer works. So clearly right now for VC&P, market in China is dominated by domestic capital, especially state-owned and local governments. They come with strings attached, including investing back in their regions. So it's just making the market very, very complicated. But I think on the other hand, if you look at the positive side, for public listings and public secondary markets, I think Western capital is coming back. So I think Hong Kong market has been the largest IPO market last year and will probably be the largest IPO market this year as well. So a lot of Western capital clearly coming back to the public market. So we see that trickle down to the VC&P market as well. Secondly, we do see a shift in the mix of overseas capital. So I think it used to be dominated by US and the European capital. Now we see probably more Asian and Middle Eastern capital.
Excellent. So we're down to 6 minutes. I'm going to end off with my final question, right? And hopefully this will end things on an uplifting note. So what, in your view, would be the one thing on your wish list, it's always good to end on a wish, right, to allow for the most deserving decarbonization companies and solutions to attract global capital and to scale? Right, I'm going to start with Suchi, because ladies first.
Quick answer is, I think to have policy certainty, I think that will enable investors to put in dollars to help this really capital-intensive type of solution, which is all kind of quasi-industrial. And we've seen that successfully done in Chinese EV sector. We've seen that done successfully in India solar. So I think that can be replicated for many other sectors in Asia.
Daniel?
I'm a huge fan of founders, so I'm going to say that people who've made money should come back and bring their friends to our field. The people who are minting money in AI, all of them should come back and introduce their friends to our field and help them catalyze some of the new innovations. Just like the CTO of Meta is now investing gigascale capital, we need more people like that because this is what happened in Silicon Valley. I'm not just aspirational. This is practical. This is what has happened in the past. The Flipkart guys are the ones who really created all the innovations that we see today in India. So I want these guys to not go become painters and do some crazy thing. I want them to come back to our ecosystem and give back to the community and put money to work.
Julian?
It's one wish, but it's pipe dream. So it's more a pipe dream than a wish. So obviously, there's less subsidies on products that are oil-based to have a level playing field. That's a pipe dream. And wish list that's happening is for emerging markets to have better banking. We need to reduce the cost of capital for these entrepreneurs. It's really difficult to do electrification in Indonesia when a scooter you need to have a 18-20% interest rate in a bank. It's really hard to invest in companies early stage when you don't see a pathway to commercial banking, even if companies are almost profitable. So that's really something that's so important in the infrastructure that we need. Definitely in the emerging markets. For developed markets, I'll reserve my position.
I think we need more role models like GenZero. I think clearly it's emerald
like we
thing
paid him.
that you guys are doing this summit and attracting, I think, people from all over the world, from all kinds of organizations. I think, for a PE firm like us, we are a startup as well. We do our part, but I think our power is limited. But I think through your connections, not only we can get in, governments, NGOs, LPs and GPs all working together and corporates, I think we can definitely make a greener future.
Thank you for that. I think my wish personally would really be for more investors like yourselves, right, to also start to incorporate climate impact explicitly, right, into their returns on capital framework. Easier said than done, but we can figure it out using carbon prices of sorts, right, to really help guide our investment decisions. But let's not take that too far. Anyway, we've covered a lot of ground, right? From geopolitics to the impact on businesses, how we invest, how we can bring capital in. So thank you very much to my very esteemed panelists for your thought-provoking answers. And I wish you all a very fruitful Eco-Prosperity Week. So thank you, everyone. Thank you.
Thank you.